Investment strategist at SJS Markets, and Piers Curran, head of trading at Amplified Capital. Piers, let's get straight into the action with you. Almost at the end of November now, in fact, approaching the end of the year very fast. What are your general impressions of where we stand in the markets at the moment?
Well, in terms of equity markets, I would say that we've been very bullish up until this point. We've been bullish up until Christmas, but I think we've actually fallen into a pattern of a kind of a bit of a monthly cycle where we're seeing the first 2 weeks of each month. So I'm talking about September, October, and it's looking like repeating again in November. The first 2 weeks of each month is very bullish as investors get a bit more risk appetite back. They see a bit of a dip that they want to get long on. As we come to the middle part of the month, that upside momentum begins to wane, and we get a bit of a flattening off for a week or so, and then the back end of each month seems to be declining in stocks. People start to get a little bit nervous about forthcoming jobs reports out of the US, etc. So I think we're seeing this monthly cycle. It is trending higher still. The momentum is waning, as I said, but we see a drop for the next 2 weeks, followed by a good buying opportunity for the first 2 weeks of December, where we'll reach new highs for the year, just.
OK, let's find out what Dariusz thinks about that. So it looks like a monthly cycle, trending higher, though. Would you agree with that assessment of the equity markets?
It's a pretty fair assessment. The key point for me right now remains that the trend is going to continue upwards as long as central banks provide additional liquidity at near zero interest rates, and as long as the outlook for global recovery remains positive. I believe these two factors will remain with us through the spring at least. So I would belong global equity markets and pretty much any other risky asset class until then.
And good afternoon, Dariusz. What about techs? We had some sell-off in some of the tech stocks today. Not surprising given the sector downgrade coming from Merrill Lynch, B of A. Would you be short on techs now? But what are your thoughts?
I don't look into particular sectors, but I believe that tech is likely to see some more volatility. However, I would say that as is for most other sectors, the trend will continue to be upwards, because remember that it's not so much sector-specific fundamentals that are driving the markets higher, but rather the fact that it's simply so easy to borrow money and invest. And as long as this kind of incentive remains, investors will continue to do so. So, buy on dips. This remains the strategy for the next several months.
I see. And let's get out to Piers now. Piers, what do you think about techs? Of course, this brokerage downgrade on techs actually triggered a lot of worries about what could lie ahead. But if you actually look at some of the numbers today, the world's #1 and #2 memory chip makers, Samsung and Hynix, actually proved quite resilient, although the contract chip makers in Taiwan had a fair bit of sell-off. What does this tell you about where techs are, especially in the semiconductor space?
Yeah, I mean, first of all, the tech sector has certainly led us during this bounce, and well, what looks to be a pretty good bull market here. Since the lows in March, tech has been outperforming. I think you've mentioned the chip producers there, and they're the key. I mean, their Q3 performance was pretty sensational, so I think that's a good indication that the tech sector is still healthy. I think that healthy growth will continue into Q4. And, I think also you've had things like Microsoft launching Windows 7, which they've said overnight has gone fantastically, is the quote. So, that's a bullish sign. I know Dell reported earnings overnight as well, which were not quite so good, but their forecasts for 2010 are pretty healthy. So I think the tech sector will continue to trend higher and probably slightly outperform the general equity markets as a whole.
Dariusz, what about Tim Geithner? You think he's going to outperform, or do you think he's going to lose his job inside of a year?
I think that he's going to retain support of the administration because it's difficult right now to find a replacement that would be willing to take the risk. And the key risk is that the political climate in the US has shifted against the increase in deficits and debts, something that is inevitable. And I'm particularly concerned about the end of next year when the current stimulus package runs out and the private demand will not be strong enough to replace it. So then another stimulus package is likely to be necessary, and it's possible that after that Tim Geithner's job will be on the line as a prize, but until then I think that he will hang on to his position.
Interestingly, Piers, both President George W. Bush and Bill Clinton's first Treasury Secretary resigned after 2 years on the job. So this would be premature by most estimates if Geithner were actually to succumb to the mounting pressure that he's facing.
Yeah, I've got similar views to our other guest there. I don't think Geithner's going anywhere. Certainly not in 2010. I think he's here to stay. It's my view.
View it is.
OK, let's thank both those guests and get on to some of the other top news of the day. Piers, thanks for joining us this morning. Piers Karen, Head of Trading at Amplify Trading. And Dariusz Kowalczyk, Chief Investment Strategist at SJS Markets. Well, the European Union has its first president, Herman